This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
The cage match continues, the daily tug of war between optimism over an improving corporate earnings outlook and the reality now setting in that the Fed may in fact not cut rates at all this year. Which prevails in any given trading session generally informs gains or losses. But let's step back from the daily fray and challenge some of the news flow we're bombarded with. What needs clarification, amplification, and in some cases, outright correction? Up next, I have a number of observations, so stay tuned. Welcome on board another edition of our Wise Investor Group podcast. I'm Simon Hamilton, Managing Director here at the Wise Investor Group of Raymond James. Glad to be with you as always. So the Dow hit that milestone, right? Hit 40,000 a couple weeks ago on cue. We promptly dropped about 5% on the index ever since. You've heard the expression, buy the rumor or the expectation and sell the news? Well, maybe that's part of what's going on here. We've seen vacillations in investor sentiment all year. Too much bullishness and optimism have precipitated modest pullbacks, and too much negativity has often led to rallies. Remember, the markets have averaged 3 or more sell-offs of at least 5% per year going back almost a century. This is nothing new, expected. But if you are looking for culpability, maybe it's this continued cage match that I mentioned, a battle royale, if you will, between earnings and interest rates. This is hyperbole, of course, but the black and white reactions to economic data and news flow certainly make the average investor feel like every day is a war. One day, the market's optimistic about improving earnings and higher estimates for the future. The next, we're tethered to the now almost consensus opinion that the Fed may not cut rates at all this year. These are sides of the same coin. It's the better earnings prospects feeding off resilient consumer demand that make it less likely the Fed are going to cut rates anytime soon. But in the short term, markets are having a tough time figuring out which force will best to the other at any given moment. No one knows how this is going to play out exactly, but I will tell you that here at the Wise Investor Group, we pay much more attention to earnings than anything else. They are by far the most important driver of stock prices over any significant length of time. It's hard for the markets to have a major sell-off. We can have minor sell-offs for any reason at any time, but it's hard for the markets to have a major sell-off when earnings estimates are going up like they are now. And of course, we'll be watching for any potential threats to the forecasts very, very closely. But for today, though, I thought I'd do what I have done a few times over the past year or two, and that is try to step back and provide a bit of a reality check, to look at some of the news, headlines, opinions, rumors I come across every day and look to clarify and in some cases correct what I think are questionable narratives. At the very least, maybe shed some light on topics that are likely not as understood or as well understood as maybe they could be. Remember our mission statement here. It's been the same mission statement for over 30 years, to help our listeners become better informed, wiser investors. I'm not going to get much into individual stock ideas today, now that we're almost entirely through earnings reporting season, but I promise, don't worry, I'll get back to that next time. So here's some observations. And by the way, what kind of precipitated this show was I read a survey, I guess it was, from The Guardian, pretty famous news outlet, The Guardian, and they conducted a poll, and they didn't say how many people they surveyed, but I thought the results were really nothing short of stunning. Get this. According to this poll, 55% of people believe the economy is outright shrinking, so not just flat, outright shrinking, negative GDP growth. 56% think the U.S. is in a recession. Almost half, 49% of the people believe that the S&P 500 index is down for the year, even though it's up over 10% for the year and up over 20% last year. 49% believe unemployment's at a 50-year high, though the unemployment rate right now, as you know, is under 4%. So you have literally, in all three of these cases, essentially half the respondents, not just with a colored opinion, completely wrong. You've seen that bumper sticker, right? You're entitled to your own opinion, but you're not entitled to your own facts. And it's unclear who the Guardian's listenership is, if there's political bias there or economic bias. It's not clear, right? And I'm not going to get too much into the credibility of the survey. But I will say those results are pretty stunning. And I bring it up because this was widely circulated. I saw this same poll probably on 5 or 6 different media outlets, and this is just a week or so ago. So there's a significant gap between people's assessments and reality. That's why I want to – it's really important that we challenge some of the things that we read and make sure we understand them. So that was sort of the backdrop for this podcast. One of the big points, of course, is inflation. And inflation is probably – I'm certainly not going to get into politics today, but it's probably the central issue. I mean, we can talk about immigration, we can talk about abortion, we can talk about all these other things that people go to the polls and vote on. But inflation seems to be the biggest trigger at this point, and it's probably the thing that's been hurting Biden's polling numbers the most. And what's interesting about inflation is the whole meaning of inflation has changed. Inflation, by definition, if you look at Webster's dictionary, is, quote, a general increase in prices and fall in the purchasing value of money. So inflation means rising prices. That's the definition. But that's not what it means in this day and age. When people talk about inflation, they're not talking about rising prices. They are talking about high prices, the fact that prices are elevated. So inflation, the whole definition has shifted here over the course of the last couple years. And I think that's kind of what's going on, is that, yes, the rate of inflation has slowed dramatically. Inflation a year and a half ago was running at 9% year over year. Now it's running somewhere in the 3s. But prices in an absolute sense are much higher than they were, over 20% higher than they were across the board than in 2019 or early 2020. And remember, prices have only dropped, like outright dropped, I think maybe a couple times in the last 70, 75 years. The last time was in 2008. Deflation in this country is a very rare thing. So you're not going to see milk and eggs and all these other things go back to where they were 4 or 5 years ago anytime soon. But the rate of increase has slowed and will continue to slow. That's what inflation is measuring. So, and it's just interesting to me because what's interesting to me is how bad the sentiment is. I mean, if I wasn't around, I was alive, of course, but I wasn't in this business in the late 70s. I know many of you listening, of course, were, and very attuned to the fact that inflation was running in the double digits, interest rates were in the double digits. Well, prices rose from 1977, March of 77 through March of 1980, according to the University of Michigan, roughly 30%. Okay? Look at the most recent period, March of 21 to March of 24. Half of that, about 15%. Yet the sentiment isn't half as bad as it was then. The sentiment readings are almost as negative as they were in the late 70s. What about the labor market? The labor market in the late 70s was much worse than it is now. The employment rate averaged over 6% from 1977 to 1979. In contrast, the last few years, unemployment rate's been under 4%. So we have a smaller increase in the price level than the late 70s with a much lower unemployment rate, yet the sentiment is just as bad. And again, I'm not here telling you how you should feel about the environment, how you should feel about who's in office, how you should feel about the economy. But the reason I bring it up is if you let this somewhat, I would argue, non-factual opinion of the economy, overly negative opinion of the economy, influence your investment positioning, maybe lead you to be out of the market, maybe just sitting with all your money in a checking account, that's where it becomes problematic. So that's why it's important, I think, to clear up some of these, what I think are potentially inaccurate narratives. Staying along the lines of the macroeconomic picture, I just talked about inflation. And there's this idea that inflation may start to rise again. Possible. Certainly cannot rule that out. Of course, what the Fed's trying to do is they're trying to temper demand, right? And that's why they keep rates as high as they are and will probably continue to keep rates as high as they are. They're trying to depress demand because when you have excess demand without a similar increase in supply, that's how you get consistently higher prices. But remember, and I've said this for the last number of months, that housing will continue to have a disinflationary impact. The shelter component of CPI, which includes both housing prices and rents, it's almost a third of CPI. So it is a big input into CPI. It's moved down now 13 straight months. But the key point is there's a really long lag factor, particularly with rental price data. Rental prices are negative year over year. Okay, that reality, I don't know, has really showed up that much in the data. So even though there are reasons to think that inflation could be stickier than we all hope for, my guess is inflation will continue to drift lower. That's not really what you're reading in the media, right? You read in the media about a reacceleration of inflation, that this is the 70s again. There isn't a lot of evidence for that. So don't think that just because the figures in the early part of this year ran a little bit hotter than the Fed wanted, that can't change later in the year. And I still think, even though the Fed's not likely to cut rates anytime soon, that is still on the docket at some point. And the other thing I just wanted to mention on sort of the macroeconomic front is I just talked briefly about the health of the American consumer. And I hesitate a little bit to sort of talk about this because everyone's experience is different. And clearly there are a lot of people in this country struggling. I think we all know that. However, it's kind of a common narrative that, rich people are doing well, lower income people are, not as well, at least relative to how they were doing, several years ago. Not necessarily the case. According to a Bank of America study that I read recently, lower income spending in the last several years, particularly the last 2 years, lower income spending has generally outpaced higher income spending by a significant amount. And not just on necessities, not just on groceries and gas, but on discretionary spending as well. And a lot of that is because of wage gains. Believe it or not, lower income workers have seen the largest wage gains over the past 2 years. So, I think you can look at it pretty in kind of simple terms. We don't have positive GDP and the stock market isn't near all-time highs because people can't afford to buy anything anymore. And for the most part, in the last 14 months in a row, wage growth has outpaced inflation growth. So that's a lot of what's going on here. Yes, prices are high in an absolute sense, and yes, inflation is still growing at over 3% year over year, but wages have grown faster. That's essentially what it comes down to. I think a lot of it is kind of perceptual. The problem with the relationship between wages and inflation is that people see higher wages as something that they earned. They got a raise or they got it through hard work, while higher prices are kind of a form of theft. So a lot of it is kind of in the way that people perceive it, and I don't blame anyone for perceiving it that way. But the reality on the ground is that people are not doing badly relative to the increase in prices. This is not a narrative that you hear talked about very much in the media, but the statistics and data show that that's the case. A lot of people ask me all the time about, interest rates, of course, have gone from 0% to 5%, as we all know, the last couple of years. And people have asked me, well, why hasn't that had a bigger impact? And there are probably a million reasons for that. Certainly, if you look at it historically, if you go back 50, 60 years, when the Fed has tightened rates this dramatically in such a short period of time, only a little over 2 years, it's almost always led to recession and a significant slowdown in consumer spending. Has not happened this time around. I think a lot of it has to do with this fact. One, according to the Bureau of Labor, 40% of U.S. homes don't have a mortgage. 40%. So for most people in this country, their homes are their biggest and most expensive asset, if I could use the word expensive. Well, 40% of people don't have a mortgage. So the fact that mortgage rates have gone from a little over 2% to over 7% hasn't impacted those people. And guess what? Half of all mortgages outstanding for the people that do have a mortgage are locked in at below 4%. Below 4%. So, most people don't have millions of dollars in the stock market or millions of dollars in the bank, but a lot of people have a home. And the carrying cost of that home has not been affected that much by higher interest rates. Okay? And you see the same thing as far as corporate debt goes. Most businesses during COVID, when rates were the lowest in U.S. history, were able to kind of term out their debt at very low levels. According to FactSet, the investment-grade bond market grew from $3 trillion in 2009 to over $9 trillion today. It tripled. And the investment-grade market is 9 times bigger than the junk bond market, 9 times bigger than the loan market. What is that telling you? It tells you that most companies, in terms of, at least as measured by dollars, were able to finance their debt at low levels and manageable levels relative to high yield rates and loan rates. That's another reason. And even though some of the economic data has slowed recently, investment grade credit spreads relative to treasuries, which is a good measure of economic stress, those have tightened, meaning that the closer yields are to treasuries, that's the less evidence there is of credit stress in the corporate bond market. When you get into recessions or on the doorstep of recessions, those spreads get really wide because people want to be compensated more for the risk of owning that debt. If you think about just a couple other things relative to the big picture, the macroeconomic picture, I think something that people forget, and again, it's not widely reported, is that the stock market and the economy are not the same thing. We've talked about this for a long time. The market's not the economy is not the market. They move in different cycles. And 2022 is a great example. The stock market got killed for most of 2022 because investors thought that we might go into recession. The stock market was front-running the economy. And then when it turned out that we weren't going into recession, the market rebounded. You see those kind of, the fact that the economy and the markets aren't in sync all the time, you see that quite often. But what also people don't realize is the makeup of the S&P is not the same as the makeup of the economy. So according to Ritzold Asset Management, for example, they looked at technology's contribution to S&P earnings. I mean, in the last year, overall year-over-year earnings growth was roughly 2.3% on the S&P. Well, technology year-over-year earnings growth was 2.9, which implies that everything besides technology was minus 0.6. Technology had a dramatically outsized impact on S&P 500 earnings relative to the rest. And you get a similar picture if you look at it from a revenue perspective. However, tech's contribution to GDP is less than 10%. Okay, so tech has a much bigger weighting in the stock market than it does in the real economy. Look at earnings. Something like 41% of S&P 500 revenue comes from outside the U.S. 41%, where, of course, GDP is a measure of U.S. output, 100% U.S. And you could look at it from other perspectives. I mean, for example, according to the same study, 87% of firms with revenues greater than $100 million are private. They're not on the S&P 500. Look at profitability. S&P 500 profits make up half of economy-wide corporate profits, even though publicly traded companies are many fewer than private companies. So tech has a bigger influence in the S&P. S&P companies tend to be more profitable than non-S&P companies. Much more of the S&P earnings come from overseas than the rest of the companies in the United States, private companies. So that's why quite often, I mean, there are a number of reasons. I just mentioned the lag factor between the economy and the market. But there are real structural differences between the S&P and the way that we measure the U.S. economy. So I say this because quite often, and I hear it all the time, people might have a certain view on the economy, either positive or negative. Sometimes that's politically influenced, but depending on who is in office. And that might lead them to have a certain view of the stock market. I suggest you check that opinion at the door because they often move separately. And kind of related to all this is, and I've talked about this for a long time, is you may have a certain view of the economy, but trying to forecast both the economy and the stock market is a fool's errand. I say this every December. Every December show I've ever done, going back over 20 years, I've said, don't buy into Wall Street, S&P 500 targets, and economic targets for the coming year. Don't buy into those because they're notoriously inaccurate. And I'm not trying to pick on this guy, but Michael Wilson over at Morgan Stanley, he's been kind of famous over the last year for having the most negative forecast for the S&P for this year. He thought that the S&P would have a negative return here in 2024. What's notable is just a week ago, he actually upped his target by a lot. He upped it by like 600 or 700 points. I don't have the exact numbers, but somewhere in that range. But here's what's notable. It's not notable that he's been wrong so far. I mean, he's a smart guy. That's not really the point. What's notable is why he was negative on the market. He was negative on the market because he assumed that valuations would fall, that investors would want to pay less for earnings than they did last year. And he thought the S&P would go from 18 times earnings last year to roughly 17 times earnings this year. Well, guess what? Forward valuations right now are closer to 20 times estimates. So not only has he been wrong, he's been wrong in a major way. And you can see how much of a difference it makes. I mean, if you look at FactSet estimates, assuming that the S&P is going to earn about $270 in aggregate over the next 12 months, 17 times earnings puts you around $4,600 on the S&P, 20 times earnings, $5,400 on the S&P. So what's that? 800-point difference? Almost a 20% difference if you get the PE wrong. The reason I bring this up is because it's notoriously hard to forecast earnings growth. Even the best economic forecasts are wrong. But when you're trying to forecast what investors are going to pay for those earnings on top of it, that introduces a whole nother level of vagary, if you will. And that's why when I get these articles in December with everyone's target, I don't even pay attention to them. I really don't. In fact, I read a study from Goldman Sachs the other day. They said something like valuations are not mean reverting, and that's essentially a myth. So, for example, if stocks are expensive for a couple years, it doesn't necessarily mean they're going to get cheap in the third year. Stocks can stay cheap or expensive for much longer than you think. And we all know about the follies of economic forecasting. I mean, earlier this year, early January, consensus forecasts, including the Fed themselves, were calling for at least 5, maybe 6 or 7 rate cuts this year. Here we are, late May, early June. We're down, in some cases, to 0. Rate cuts have been almost stripped out of the consensus. And the Fed's estimates tend to be some of the least accurate. But the headlines that you read on a daily basis, a weekly basis, they are always saying this analyst predicts that, or this analyst, has a certain model a certain forecast that you need to listen to. I don't listen to any of that stuff, and I suggest you don't either. The last thing I'll say on the macro front, and I've said this for years, we don't make forecasts here at the Wise Investor Group. We do look at the weight of the evidence. So we generally have a feel about the economy or a feel about the market, and we try to take into account as many inputs as possible. One of the things that often gets people into trouble is relying on a single piece of data or a single input. One of the biggest things that comes to mind recently is the inverted yield curve. Okay, as you may know, in a supposedly healthy economy, generally speaking, over the last 60, 70 years, short-term rates are lower than long-term rates. What's been the case recently? It's been the opposite, right? You can get 5.25% on a short-term treasury. Longer-term treasuries are in the mid-4s, and it's actually been more inverted than that in recent memory. So, and if you look at it historically, most recessions in this country have been preceded by the yield curve inverting. So that's why so many people, so many headlines, so many analysts, so many economists were saying, you've got to be careful because we're going into recession. That's the signal the yield curve is sending. Guess what? Not only are we not in recession, we're not even close to being in recession. Maybe that changes in 6 months or 12 months, but I don't think that should be anyone's base case today. The lesson is, often when you read an article or get a soundbite from a cable TV program, it's focusing on one data point and saying you should do this or you should do that because of that one data point. Generally speaking, that'll get you into trouble. Look at the weight of the evidence. That's something that we do here. Just a few other things that come to mind. I've talked a lot about earnings, and it's really easy, and I don't blame anybody for doing this, but it's really easy to get distracted, to get off course because there's so much sort of negativity that's being thrown your way by the headlines, right? I mean, just look at it recently. Gaza, immigration, abortion, political dysfunction, the Trump trials, all these things that are certainly important to us as citizens, that matter to us as citizens. But guess what? They don't influence stock prices anywhere near as much as you think. You know what does influence stock prices? Corporate earnings. And what you may not know, it hasn't been reported that much. Not as much as you would think. I mean, it's got much less airtime than the Fed and inflation and politics and all these other things. But the fact that earnings are better than anybody thought they were going to be. I mean, going back to January, the consensus was for this most recent quarter, the first quarter, the earnings would be up about 7% year over year. Well, they came in at 8%, and they would have been higher. Bristol-Myers had a $12 billion charge against earnings. If you strip that out, earnings would have been over 10% year over year. But the key point is earnings estimates not only for this year, but also 2025 have gone up. 2025 estimates call for 14% year-over-year growth. This is all according to FactSet. So as I said at the very top this morning, you can have 5-10% sell-offs for any reason, right? Sometimes it's just the market got too fat and happy. People got too complacent. But big-time sell-offs, 20, 25%, 30% type declines, like we saw in 2022. Those are almost all associated with the expectation of falling earnings, such as happens during a recession. When earnings estimates are going up, the caveat is we don't know what's going to happen a year from now, but when estimates are going up, really hard for the market to have a significant pullback. And by the way, if you're trying to game the system, if you will, if you're trying to day trade the markets, by hopping in and out, maybe selling after bad news, hop back in when you see some momentum. I always talk about how a lot of the market return is concentrated in a small number of trading sessions. Well, according to Mark Holbert over at MarketWatch, as of a week ago, just 9 days this year, 9, account for all of the stock market's gains. And none of those 9 days were back-to-back. Think about that for a second. If you were, a day trader, or if you were trying to, go to cash because you read something, a negative headline, you tried to hop out, you missed just 2 or 3 or 4 of those 9 days, it's very possible you have a negative return this year. Because guess what? As of this morning, according to FactSet, 45% of the names in the S&P are negative for the year. 45%. And the S&P's up, I think, around 10 and change. So not only do you have to have the right type of exposures to the market, but you also have to be in the market. Both of those things. Just a couple other things I wanted to get to here, kind of on the macro front. I don't want to talk too much about the election. I may talk about it more later in the summer, early fall, as we get closer to it, about sort of the investment implications of the election. Certainly Trump has espoused certain things. Biden has espoused certain things, which, if enacted in full, would be consequential, right? Although we know there's a big difference between politics and policy. Also really depends on what happens in the House and the Senate. For example, tax changes are very challenging to put through if you don't have all three, like Trump did when he was able to get his tax cuts through. So I'll talk a little bit more about the market impacts at some point. But just in a general sense, I think there's this kind of narrative out there that election years are problematic for the stock market. Well, the data suggests that that's not the case. In fact, according to Piper Sandler research, S&P, going back to 1930, the S&P has averaged a 7.5% gain in the fourth year of a presidency. 7.5%. What's even more interesting is if you kind of drill down and look at the performance post-election through the end of the year. So whenever that is, early November through the end of the year. And what's interesting about that is the performance is no different, again, according to the same study, than normal. If you plot the average performance of the 18 election years and 56 non-election years that they went back, 76 years, I guess that is. While the S&P tends to perform a little worse in the first few days after the election, there generally isn't any lasting impact. In fact, the average return following Election Day through December 31st is 2.3% in an election year versus 2.4% in a non-election year. Statistically the same. So to think that even in an election like this, where obviously you have some polar extremes in philosophy and platform, like you do between Trump and Biden, there's no reason to think that other than a few days after the election that we're going to get significant bout of volatility either after the election or even before the election. Again, I will speak more to what we might expect in a Trump presidency or Biden presidency at some point later, but I just wanted to make that point because if your inclination is to get out of the market before the election or get significantly more conservative before the election, I might push back on that and say, you know what, maybe you're right this time, but history doesn't suggest that that's the right call. Last thing I just wanted to bring up is, and I only bring it up because it's been in the news, there was a number of articles, you may have seen it, Fox, CNN, all kinds of outlets reporting that Social Security is in trouble, which of course is not news to anybody who's been following Social Security. But the idea that Social Security would be in big trouble starting in 2035. Just to give you a little bit of background on Social Security. Social Security is a big deal. For 4 out of 10 retirees in this country, according to SSA.gov, 4 out of 10 rely solely on Social Security for their retirement income. Solely. And without Social Security, as a result, 4 out of 10 senior citizens would be below the poverty line. That's a big deal. Nearly half of senior citizens get 50% or more of their income from Social Security, and 1 in 5 people 65 or older get 90% of their income from the program. So that's why these, any kind of articles about Social Security solvency are very relevant. As you may know, there are kind of 2 parts to Social Security. There's the so-called Old Age and Survivors Insurance Trust Fund, which pays retirement and survivor benefits. And then there's the Disability Insurance Trust Fund. Okay. Well, the first one, the Old Age and Survivors Insurance Trust Fund, as of the most recent actuarial study, will be able to pay 100% of benefits until 2033. After that, it's supposed to be almost a 21% overnight haircut, down to 79%. The Disability Trust Fund is not expected to be depleted over the next 75 years. If you combine them together, which is a hypothetical exercise, but let's say you do that, you're essentially saying by 2035, Social Security taxes will cover about 83% of benefits. So I bring this up because obviously that's not great. Not great to see that program potentially imperiled. However, we talk to clients all the time, literally every week, who say, well, don't put Social Security in my plan. It's not going to be there. That's inaccurate, I think. Okay. Obviously, we can model things however you want us to model things, but it's not going away. Social Security will be there. It's just a question as to whether the benefits are haircut. And by the way, if you look at it, if you go out 75 years, it's expected to be haircut about 30%. So at some point between 2035 and 75 years from now, as the numbers stand today, your benefit might be haircut somewhere between 20 and 30%. Yes, that's obviously negative for a lot of people in this country. For our clients, negative as well, but not a disaster for most. And obviously there's a lot that they can do, right? I mean, they can raise the payroll tax, they can lift the cap on earnings subject to the payroll tax, they can increase the full retirement age, they can reduce the benefits of higher income earners, they can slow the growth rate in benefits, like lower the annual COLA. So there's a lot of levers that they can pull to make it so that there's no haircut to benefit. But I bring this up, again, because the headlines are suggesting that Social Security is going to be completely bust in what's that, 10, 11 years. There's no evidence that that's the case, and the actuarial studies that have been done say that that's not the case. So I know this was a bit of a laundry list, covered a lot of different areas, macroeconomics, the market, Social Security, the election, but the common thread is that these are things that if you just read the headline, if you just read the cable TV soundbite, you might come away with either a half-truth or an issue that's you're only looking at one angle out of multiple angles. And the problem is if you just rely on that, there's a good chance that you might be positioned in a way that's not favorable to you from an investment standpoint. Hopefully I've been able to shed a little bit of light today. As promised, next time we'll get back to talking about some individual companies, some individual stocks. Make sure you have some ideas there to consider. Until then, as always, I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.